Alright, good evening everybody and welcome back to Walks in Wall Street. Today is October 25th, 2023. It's 10:22 p.m. Eastern here in New York City. And check it out. You're overlooking 432 Park Avenue, right from my favorite building in all New York City, the Seagram Building. So we'll do a quick recap on the markets. The S&P 500 was down about 60 points today, or about 1.5%. And we are now trading below the 200-day moving average. So the likelihood and the probability of further declines in the equity market seem relatively likely. We'll take a look at the Dow Jones Industrial Average, or the Dow 30. We are also trading well below the 50 and the 200-day moving average. And last but not least, the NDX, the NASDAQ 100, which has all of those high beta growth stocks, is trading below the 50-day moving average, but is fast approaching the 200-day, which sits at 14,000 even. The NASDAQ was down 364 points. This is the NASDAQ 100, down 364 points, or about 2.5% on the day, accelerating the sell-off on heavy volume. But it wasn't all bad news. Corporate earnings continued to roll out, with Meta, ticker symbol META, reporting a great quarter, beating on both the top and the bottom line. Profits up over 100% year over year. Earnings per share came in at $4.39, beating analysts' expectation of $3.63. Revenue also beat on the top line, $34.15 billion. Average daily active users increased to 2 billion people using all of the Meta platforms from Facebook to Instagram. Really insane growth. ARPU, or average revenue per user, also increased to about $11.23. Analysts were expecting about $11.05. I think the biggest talk of the town is still Meta's Reality Labs division, which focuses on the virtual reality and augmented reality technologies, lost $3.74 billion in operating losses for the quarter. That means it's now lost close to $25 billion since the start of the last year, and that's right around when it released its Quest 3 headset. So, look, Facebook or Meta is able to afford to lose all this money, right? Because they're making so much money on the advertising from Facebook and from Instagram. They can use those profits to funnel into research and development to produce these new products and services. Now, I don't know if virtual reality is going to take off. I don't know if the metaverse is going to take off, but there's a lot more smarter, educated, and capable people at Meta that think so, and they're investing billions and billions of dollars to that. Now, in our last live stream, we talked about the really mind-boggling podcast on the Lex Friedman podcast with Mark Zuckerberg as they demoed the new Quest headset. If you haven't seen that, please go check it out right now. The last thing I want to talk about tonight, let's take a look at the Russell 2000, or the IWM. Now, the IWM is the ETF, the iShares Russell 2000 ETF. So, small cap companies. We are trading well below the 200-day and the 50-day moving average, and we're trading at 52-week lows. There's a couple reasons for this. And tomorrow, after the closing bell, I'm going to send everybody a copy of all of my research. So I wrote a research piece. One of the topics that we cover in the research is going to be the impact of higher interest rates on smaller cap companies particularly. Why are higher interest rates impacting the valuations and earnings of smaller companies as it relates to the comparative analysis of larger cap companies? Now, it all has to do with debt. Right, a lot of companies in the Russell 2000, I'm sure, as you've heard, are zombie companies, which essentially means they need to bring on debt acquisition in order to fund their operations in perpetuity. But if you look at a company like Apple or Microsoft or Meta, who is flush with tons of cash on the balance sheet, Well, they're probably going to have a mitigated experience or reaction to rising interest rates. If you look at the amount of long-term, long-dated debt that is due to mature for Russell 2000 companies, the vast majority of that debt is going to need to be refinanced within the next 4 years. So assuming these companies need to take on new debt to fund their operation, well, it's going to be at significantly higher interest rates, and the problem is they're not earning enough money to be able to properly service that debt. So this is very important. So if you want to receive that, everybody, just a quick announcement. Tomorrow after the closing bell, I will be sending out the second edition of the Behind the Street newsletter. So if you scan the QR code on your screen, you can read all of our archived research, and you can punch in your email to be subscribed for free to our mailing list, where every other Thursday after the market closes, you will receive our research. I want to quickly take a look at gold. If you look at a monthly time frame of gold, it's one of the most immaculate bases I've ever seen. Now, over the last 2 weeks, we've had a massive rally in gold, all the way from about $1,800 an ounce, just now sitting shy of $2,000 an ounce. Now, that's the physical gold. I think it's also appropriate to take a look at the digital gold, or the digital asset that is called Bitcoin. So Bitcoin right now is trading at 34,700. I believe we're up about 20% over the last 2 weeks. We're seeing this continued flight to safety, flight to quality. And if you think about a true unconfiscatable asset, if you think about something that is immutable, if you think about something you can only control, and if you look at the situation going on in China, particularly in the commercial paper market, you're seeing a lot of wealthy Chinese individuals, ultra high net worth, trying to get their money out of China. They're doing all illegal ways, all backdoor, underhanded ways to try to do that. Had they had exposure to Bitcoin, they could move that cash anywhere they wanted in the world for pennies on the dollar, for essentially free. So that's another thing we're going to be talking about in tomorrow's research piece. All right, everybody, it's going to be a short stream. I just wanted to restart that broadcast, mainly because just a lot of crazy things going on in the world, and I just wanted to, just start over, do a quick restart. We're going to be on for about maybe 20 minutes. So, let's get started. All right, here we are. We are outside of the beautiful Seagram building tonight. Hey, Tariq Khan, what's up? Thanks for joining us. Joan K, Hawaii, MBA Elias. This is a gorgeous shot of 432 Park Avenue. Just a really stunning building. Madison 32 says, Tom, I watched Leon Cooperman on Fox Business today. I think I saw that segment too, and he feels that a recession is still very possible in the next year. I think it's still very possible as well. Now, where I agree with Leon Cooperman is that we're going to be in a higher interest rate environment for longer. So it's definitely going to be higher for longer. That I do agree. And I think that's going to create a lot of big opportunities. I think you could potentially have equity-like returns in the bond market or the debt market, particularly private credit. Maybe we'll go into that and review that another day. You know, if you just look at treasuries, right? Now, if you're a big pension fund manager or something like that, you know, you can't afford just to have a safe bet of 5.5% risk-free from the U.S. government, right, from the Treasury. I believe pensions, in order to have their funds fully met or fully funded, they need about a 7 to 10% annualized return. That's what most pension funds need. But for individual investors, right, let's say if you're liquid like $2 or $3 million, if you look at the Treasury market right now, you can get risk-free rate of return of 5.5%, right? And there's even a lot of liquidity in money markets right now. So if you have your money in, a brokerage account or whatnot, you can have that intraday liquidity that you need. And institutional money market funds are quite competitive with Treasury rates. So, as you look at fixed income as an asset class, it hasn't really been attractive over the past, I would say, decade, right? Due to the Federal Reserve artificially suppressing interest rates. But think about it like this. Now that rates have gone up materially, the Fed funds rate right now is in a target range of 5.25% to 5.5%, and the risk-free rate on the 10-year U.S. Treasury is about 5. Well, if you look out to the farthest end of the curve, so the 20-year and the 30-year, assuming if you have a long-term time horizon, if you were to increase your exposure, right now I'm not telling anybody to do this, but we're just sort of playing the idea around in our head. If you increase your exposure to long-dated bonds, not only are you going to be making an attractive yield risk-free, right? And I say risk-free because the US government has never defaulted on its debt obligations, but maybe in 2 or 3 years, when interest rates start to come down, well, guess what? You're probably going to get equity-like returns on those bonds as the prices of those bonds go up. We'll go in the bike lane here. So again, you got to understand the correlation in the bond market is that as prices of bonds are getting bid up, yields come down. And as you have a sell-off in the bond market, as people are selling bonds, yields go up. So when it comes time for the Federal Reserve to finally start the transition, right, and I don't know when that's going to be, by the way, but when it comes time for the transition away from quantitative tightening or QE, or QT, to quantitative easing and QE, well, guess what? The people who had very high bond exposure that were making those pretty decent yields are also going to benefit from the upside of the bond price appreciation. And this has been exactly quite contrary to what a lot of banks have been doing since 2021. We talked about Bank of America's earnings report last week, and what was one of the biggest sore spots of Bank of America's earnings? Does anybody remember? As we look at Jefferies here, one of the biggest sore spots of Brian Moynihan's company is they have a lot of mark-to-market losses in their long-dated mortgage-backed security portfolio. Because in 2020 and 2021, when the Federal Reserve had to drop interest rates to zero, well, guess what? A lot of the mortgage debt, that is very safe debt, by the way. It's not like they're speculating in toxic derivative instruments. But all of that long-dated mortgage debt had sub 3% interest rates. So guess what? Any institution or bank who is piling into those long-dated MBS bonds, well, now they're technically in a big, big world of hurt. All right, no more. So yeah, they're going to be in a massive world of hurt right now. So Bank of America is underwater quite a bit, And they're not the only ones, particularly a lot of the regional banks that have a lot of exposure to, CRE debt and the like. So that's definitely a good outlook. Hey, MBA Elias has just took a position on some muni bonds. Decent investment at the moment. Very interesting. Now, MBA Elias, how are you expressing that view by chance? Hey, 350 MPH Media. This is good info and good analysis. Thank you so much. Rockstars is Bank of America and Morgan Stanley made new 52-week lows. And same with a lot of regional banks, right? A lot of regional banks are, falling under pressure here as well. But check out, I think it's important right now to pay attention to a lot of small caps, right? So you think about Russell 2000 or the IWM. Ticker symbol IWM is the ETF that tracks the Russell 2000. And, if you think about more well-capitalized companies in the S&P 500, right, particularly the top 10 companies that make up the vast majority of the market cap, Microsoft, Apple, Meta, and the like, well, they have a lot of cash on the balance sheet, right? So I wouldn't say they're totally shielded from the interest rate volatility and rising interest rates. But I think they're going to be a lot less impacted than some of the smaller, even some of the zombie companies, right, that have been essentially allowed to exist over the last 12 years due to artificially suppressed rates. Right? Because Bank of America put out an interesting research report saying that over the next 4 years, companies in the Russell 2000 are going to be hit with a tidal wave of long-term debt maturing. Now, chances are if they need to go back into the capital markets or, borrow money, it's going to be at significantly higher rates. And the problem is, a lot of these smaller cap companies do not have robust earnings, if any earnings. So how are they going to service all of that very expensive debt? Chances are they're not going to be able to. So one of the positions that I'm viewing is, I think you're going to see a really substantial uptick in bankruptcies and even some takeovers. And this is only going to benefit the very, very strong balance sheet, well-capitalized companies. And I think they're going to be able to purchase and take over a lot of really good businesses that are unfortunately just not going to be able to service their debt obligations. So we'll see. MBA Elias's municipal bond yields at the highest in more than a decade. In addition, yields on treasuries and munis have reached a point where people are ready to buy. I agree. Now, MBA Elias, I have a question for you. But if you enjoy the conversation that we're having, I'm going to publish this thesis and email it to everybody tomorrow, right? So tomorrow after the closing bell, if you scan the QR code on your screen or type !news, NEWS in the chat, and click the link, just punch in your email and you could view all of my archived research for free, as well as receive the next edition of the Behind the Street newsletter. But my question for MBA Elias is this, and I saw this in an interview. I actually think it was Stan Druckenmiller. And Stan Druckenmiller said the following as it relates to U.S. debt. So our national debt is at an all-time high, right? Continues at a blistering pace into an all-time high. And the Fed, he thinks the Fed is going to be forced to pivot, mainly because it's going to become impossible for the United States to service its debt obligations with these high interest rates. So it seems as if over the last 12 years, the United States was able to go on a spending spree and rack up as much debt as possible because money was very cheap. And now that we have all this debt outstanding and interest rates are going up, well, it's going to cost us billions and billions and billions and billions of dollars more a day just to service this debt. I don't know. Any thoughts? Do you think that... Now, I understand the Fed has to work independently of the federal government. The Federal Reserve is not part of the government. They're independent entities, right? But, you know, going into an election year, a little nudge by the Biden administration to say, hey, I don't know. This is 53 West 53rd Street here. Hey, Michael Joseph, what's up? All right, let's head to Columbus Circle because that's where I need to get on the train anyway. Hey, NMB 045. So good to see you as always. Thanks for joining us. This is the Steinway Tower. This is the skinniest residential apartment building in the world. MBA Lies is also the uncertainty of next year's funding crush is filtering out the steepening yield curve via the term premium. Vivian says you like I bonds. Yeah, I mean, I don't know. We'll see. It does. I think equities, on the equity side, the breadth of the market is just so sick. I think about only 20% of the stocks in the S&P 500 are above the 200-day. So that is some serious weakness. This is the Alliance Bernstein building, but also in this building is Fortress Investments. I was actually just watching an interesting interview with Michael Novogratz. And Mike Novogratz, after he got out of the military, he went on to work at Goldman Sachs, worked his way up to a partner at Goldman Sachs, and he was at Goldman Sachs right as they IPO'd. Then he went to Fortress. So I think he's been through 3 IPOs. So I mean, just do the math on you know, what that guy is worth. Probably multiple billions. And now I think he's broken off and created Galaxy Digital. Texas's will ELF stock increase? I have no idea. No idea. Hey, Hang with Mark Baum says, what's this about I-bonds? I had made sloppy joes with the family. I think NBA Live says he's increasing his exposure, or maybe with somebody else. Now, 56th Street was shut down today, in between 5th Avenue and Madison Avenue, because of Trump's court cases. Rockstar says, Tom, $500,000 for dinner with Ken Griffin? As in, I have to pay $500,000 and I get to have dinner with Ken Griffin? No, absolutely not. I don't know. I mean, what do you guys think? Like, some people, I see those questions sometimes going around of people saying, hey, I would spend, you know, $200,000 to have dinner with Warren Buffett. I don't know. I just think that it's probably not worth it. And here's why I say that, right? Here's why I say that. The internet has made every single thing you need to know so readily available. If you go on YouTube right now, you can quite literally consume hours, hundreds of hours of interviews, of financial investment seminars with all of the greatest investors of all time, just getting asked questions. Warren Buffett does the Berkshire Hathaway shareholders meeting, and that's broadcast for free. It's actually live streamed on YouTube. So all of that stuff is available for free. And the internet has made that possible. So you could just just consume all that content. Now I get it. The relationship building is important. But I would rather try to build a company or advance in my career to get near those power players instead of just writing somebody a check for $500,000. I don't know, do you think I'm wrong with that? Hang with Mark Mom says there's so much free information out there, just soak it all in. Yeah, and I think Ken Griffin would say the same thing. I think if you said, hey Ken, would it be a good idea for somebody to spend $500,000 to have a dinner with you? He'd probably say no. You should use that as seed capital to start your business, invest in companies, you know, buy your family a home, or do something. You know, and now the internet is so wild that you'd be surprised. You know, if you create a Twitter account or if you create a YouTube channel and just post your content, post your analysis, you know, add value, you'll have people of that caliber, you know, in contact with you. You'd be surprised, right? If you're a really good software engineer and you're posting all of your code on GitHub, somebody may recognize that. You know, if you are a good stock analyst and you post all of your equity research online for everybody to read for free, maybe a notable hedge fund manager will notice and hire you, and maybe they'll give you money to manage. Something similar to that happened. Hold on, let me just cross the street here. So I want everybody to look up the story of how Mark Zuckerberg acquired the Quest headset. It's something very, very similar to what I'm talking about. Now, I won't give away the whole story, but the person who sold the Quest headset to Zuckerberg was minted a multi-billionaire. And the way he got to that point is just by making good products and services and publishing his findings online for free. So you never know. That's literally the story of the Meta Quest headset and how Mark Zuckerberg came to buy that company. Is the kid was just building video games and little trinkets in his garage, and he was posting on online Reddit forums. All right, speaking of Ken Griffin, this is 200 Central Park South. And I believe Ken Griffin owns the top, well, I think the mid 3 floors, but they're amazing, amazing units. And he owns them right here. But we are approaching 59th Street, Columbus Circle. And I think we'll call it a night. It's been a crazy night. It's been a crazy day. Thank you all for joining. I appreciate it. If you enjoyed the stream, feel free to leave a like on the video. Click the subscribe button if you're new. Stay safe, everybody. It's crazy times in the world. Look alive, keep your head on the swivel, and be kind and nice to one another, always. Again, tomorrow, after the market closes, we're going to send out our newsletter, so check your email right around 6 o'clock Eastern time. You'll be able to read the latest edition of the newsletter. If you haven't signed up, just feel free to scan the QR code, punch in your email, and you will receive our research piece tomorrow after the bell. So all of our moderators, thank you so much. Hawaii, appreciate it. Penelope, sunshine after rain. Happy Thursday tomorrow, everybody. And we will see you all tomorrow. Again, try to have compassion and just do something nice for somebody tomorrow. We'll leave it off with that.